How's it going, everyone? Today, we're going to be talking about inflation, and we're going to be breaking down four different terms that include this hot topic word. I oftentimes hear these terms being used interchangeably, and it's really important to understand the differences and what they exactly mean and why they're important in different ways when confronting this big inflation topic. We're also going to dive into some of the data, some of the charts, looking at some of the different sides of the monetary and credit landscape. And we're going to try to put all these pieces of the puzzle together to formulate some kind of reasonable expectation on inflation in the future. I talked about some of this in my last video about inflation, talking about whether or not it's transitory. And so this will be basically building off of that video. So if that sounds interesting to you, then stay tuned. I'm on a wave, slept on, no, I got next on. So today we're going to be talking about monetary inflation, credit inflation, consumer price inflation, and asset price inflation. So first off, with monetary inflation, I have talked about monetary inflation as well as credit inflation and monetary and credit deflation in a previous video. And I went a bit more in depth just on the definitions and examples and whatnot. And so I'll put the link to that video in the description below for those that are new to this topic. But in this video, we're just going to go a little bit more surface level with the definitions and dive deeper into this topic. So just for a review, monetary inflation is simply the expansion of the money supply. So as the money supply is growing, as there are more units of money in a given system, that is a sign of monetary inflation. So that's what it is. Now the question is it happening today? And we can simply go to the FRED database and look at M2 money supply. We can see just over the last 60 years, it's been a very clear trend in an upward trend of money supply growth. And if we break it down here, we just go look at the last several years, we can see that there has been a substantial increase in the rate of money supply growth starting right around 2020 in response to the pandemic, given the actions of the Federal Reserve and the government. And so this is the M2 money supply. This is not the most, this is probably the broadest measure of the money supply that's available, but it's really important to remember that this metric is only showing money supply that is in the United States. And so obviously the US dollar is a global currency, it's the world reserve currency. And so this doesn't give us a complete picture of money supply growth in the total currency market, but it does give us some kind of idea of how the money supply is looking in the domestic system. And so a lot of people are concerned because we've had this consistent growth rate, and then this rate of growth has just shot up in the last couple years. And a lot of people are thinking that given this increase in the supply of money, this monetary inflation that we're seeing, that's going to translate to higher prices in the real economy. And given what's happened over the last several months with increased price inflation in the economy, a lot of people are using that as confirmation that this is in fact the new trend, and that we're going to see a repeat of let's say a 1970s kind of great inflation where you had price increases of well over 10% for over a decade. Now, I'm giving a little bit of pushback to that because I don't think this is the same kind of situation, but I'm going to explain why in this video, and we're going to look more at the data as far as why it's not all pointing towards this kind of secular shift to inflation, if you will. So this is the first thing. Monetary inflation, it's definitely happening. Now, the last question would be, well, why is it happening? And the main thing, at least the main reason why this chart is showing a sharp increase in the money supply, according to M2, is because of what the Federal Reserve is doing in a lot of their quantitative easing programs. The Federal Reserve can expand the money supply at will, given their monetary policy tools And one of them that they have been using for well over a decade is quantitative easing. And that's basically them establishing bond buying programs and exchanging bank reserves with banks in return for bonds and other kinds of securities. And their goals are to achieve some kind of financial stability in the financial economy, and also being able to stabilize interest rates. And that's what a lot of their uh, alleged goals are with those programs. Whether or not they're actually effective or not, that's a whole other conversation. But the result of these actions include an increase in the money supply, because those bank reserves that banks get in return for flipping the bonds to the Federal Reserve increase the money supply. And so it's basically creating new money, if you will. Now, the problem with that is that it depends on what your definition of money is, because those bank reserves aren't really being used in the real economy. They're only able to be used between other banks until they're actually used to back up additional lending into the real economy. So that's getting into another topic. So the main thing that I want to express in this part of the video is just that when we look at monetary inflation as just simply the expansion of the money supply, according to the definition of money that's being picked up in this chart, yes, we are having monetary inflation. We are having monetary expansion because the amount of units that are being picked up in the M2 are increasing. There is a lot of activity happening in the financial economy, with the Federal Reserve doing all that they can to try to create as much liquidity to keep things rolling, and to keep to try to keep away from another kind of liquidity crisis like we did have in 2020. But that's not necessarily translating in additional units of money in the real economy, because all of those units of money that are being created artificially in the banking system between the Federal Reserve and commercial banks are basically trapped in the financial economy until lending occurs. So that brings us right into the next topic, which is credit inflation. So let's bring that up. And credit inflation is basically the other side of the coin of monetary inflation. So monetary inflation is the expansion of the money supply. Credit is the expansion of the availability or the access to money. And so credit really does serve a very similar purpose and has a very similar effect to monetary inflation, because when someone has more access to money, their relative purchasing power, it's basically the same thing. It basically acts just like money, because let's say a business gets a line of credit, then that line of credit can be used just as real money is used. And so their purchasing power increases, and they're just going to spend more on average as well. And so credit is really, really important because it's very similar to money in this respect, but it's also very important given the construction of our monetary system, because credit and credit expansion is the mechanism that's used to transport money that's trapped into the financial economy and the banking system. Credit inflation is how that money gets from the financial economy into the real economy, into the hands of people like you and me, and businesses that are operating near consumers. That's the real economy over here, and then the banking system, the financial economy, that's more that's kind of trapped and doesn't have as much velocity and real direct effects to prices in the circulating supply of money in the real economy that we are constantly in contact with. So credit is really, really important. And it also, I think, reflects kind of a true picture of economic sentiment and productivity and opportunities. It's very important. So let's take a look at credit. So we know monetary inflation is definitely occurring, but let's check out credit. So we'll go over here. We're going to look at a couple we've got right here consumer loans. And if we take a look, zooming right over here in the last several years, this is looking at the last 20 years. And we have had a very large dip after the economic shock back in 2020. And we have not really had much of a recovery. We're seeing a little bit of an uptick in the last 4 months or so. But the trajectory of this prior trend is going to be really tough to get back to, where there's this massive gap between the prior trend and where we are right now. It would take a massive amount of growth to get back to that previous rate of growth. And so this is kind of concerning, I would say. It's almost like we're in this deep valley here, and there's not a lot of credit expansion happening in the consumer sector. If we go to loans and leases here, and we zoom back in, this is going all the way back to the 1970s, but we zoom in the last several years, we kind of see a similar picture. We had this dip, and we're kind of just at a flat line. And this one doesn't look quite as bad, because here, if you kind of draw a best fit line, we're not super far off the trend, but again, the slope of this is basically flat. And so we're definitely off where we would want to be. And so that's another concerning sign that you're not really seeing any credit expansion happening in this sector either. Lastly, I want to check out commercial and industrial loans. If we zoom in here, again, very, very similar picture. This is one that even looks worse, because this decline, the line is still pointing down. So we're still experiencing credit contraction in the commercial and industrial sector. And that's really concerning, obviously. And this is a very deflationary when just looking at credit. So we're seeing two different pictures. We're seeing monetary expansion, according to M2. But at the same time, let me zoom this back out. And at the same time, though, we're seeing credit contraction in basically every sector, or at least stagnant growth in credit, and growth that is definitely off of the prior trend. So this is very concerning, and I think this is a clear reason when looking at this divergence between monetary growth and credit growth. I think it's one of the key reasons why the Federal Reserve looked to the government to implement as much fiscal policy as possible, because the Federal Reserve kind of ran out of tools to try to spur any kind of inflation. Because one thing that they were doing with quantitative easing, obviously, as they're buying bonds, they're kind of being a buyer of last resort, and they're elevating bond prices by being a continual buyer of bonds. And since bond prices and yields have an inverse relationship, they're basically putting downward pressure on yields to keep interest rates low. And so that was one way that they were trying to stabilize things, because obviously if interest rates start going up, then the cost of borrowing goes up, and that puts a lot of pressure on people borrowing, and that could start breaking down debt markets and everything. It could get really ugly. And so that was one thing they were trying to do. But the other thing is that they're trying to get inflation to go up for a lot of reasons, but I'm not going to get into that in this video. But that was one of their main things. But given that the banks weren't really increasing the amount that they were lending into the real economy, they weren't really getting any kind of real injection of currency into the real economy. It was just all being trapped in the banking system, as banks were holding excess reserves and whatnot. And so I think this is a big reason why Fed Chairman Powell was very supportive of the government doing as much fiscal intervention as possible, because of this bottleneck in the monetary system, because they weren't able to obviously force banks to lend into the real economy. And so they were needing some kind of direct injection of currency stimulus in order to get around the limitations of the banking system. And so that was, I think this is very clear. And so it's showing that there is something wrong at the base level, that either banks aren't willing to lend enough, or they don't see the upside in lending, and or people don't see the upside or the opportunities um, in the economy to warrant them to borrow money because the risks are too high, or just there's no opportunity that's worth the risk that of taking out that loan, because they have to eventually pay back that loan plus interest. So um, now this is really something interesting. I'd love to get your thoughts in the comments below, because this is something that I um, haven't really understood. But well, I'll just show you to kind of get your thoughts on it. But when we look at, and I've shown this chart before, this is looking at the amount of banks that are tightening versus loosening their lending standards. And so above this zero line right here basically means that at this time banks are tightening their lending standards. So they're risk off, and they are making it tougher to their criteria for lending is becoming more strict. Whereas when this line goes below this horizontal zero line, then that's basically meaning that on average they're loosening their lending standards more than tightening. And so when looking at this chart right now, this goes back all the way to the early 90s. According to this chart, banks are loosening their lending standards, and they've been loosening them since Q2 of 2021. So it's really important to know that this is a diffusion chart. So when they're above this line, they're still tightening, and it doesn't necessarily mean that, given that this line right now is at the lowest that can be seen on this chart, it doesn't mean that banks are looser than they were back here in 2008 and 2009 before the housing crisis. It just means that banks are loosening their lending standards from very tight standards that were occurring back in 2020. Banks were really, really tight, and now as of Q2 of 2021, they're finally starting to loosen them. So this doesn't necessarily mean that they're that loose, comparatively so, but it does mean that that banks are showing some kind of relative optimism towards the economy moving forward, which is a positive thing. And yeah, I think it's a positive thing. The problem is that this is still not translating into any kind of credit expansion. We're seeing a little bit here and a flat line in loans and leases, and still a continued downtrend when looking at the commercial and industrial sector. And so, does this mean anything? Is this just another short-term kind of blip in the chart that's going to reverse and return back to tightening levels as there's another economic shock? I don't know, but this is very interesting development, and something that is kind of conflicting, because you're seeing monetary expansion that's been happening year over year. You're having credit contraction and stagnant growth, but then you're having banks starting to loosen back up. I don't know if that's just going to be a temporary thing or not, but definitely something that I wanted to show in this, because I think it's quite interesting. It could also suggest that while banks are willing to lend a little bit more to try to get a little bit of exposure to risk, to try to get some kind of returns in this environment, it could suggest that borrowers aren't as willing to engage because of lack of opportunity or lack of demand for credit. And that's another thing. It's like there's so many unintended consequences and so many different kinds of variables to where it works itself out one way or the other. But whether or not it's lack of demand or lack of supply of credit, and that banks aren't willing to engage in lending, but they're just loosening from very, very tight levels. Either way, credit is not expanding. That's really the main thing that's important to understand from these charts that I'm showing. And so, yeah, definitely let me know in the comments below if you have any thoughts about that, and whether or not you have any theories as to why banks are loosening their standards, but still credit is very stagnant, to say the least. Now, next, we're going to be breaking down consumer price inflation. This is pretty simple. I've talked about this in my last video when breaking down the topic of whether or not this kind of price inflation that we're seeing in the economy is going to be long run or short run, or transitory or not. But consumer price inflation is just simply prices going up in the real economy, the cost of living going up, the prices of goods and services in the real economy. It doesn't have anything to do with inflation. Now, consumer prices may go up as a result of monetary and credit inflation, but these two, again, are completely separate things. And why they're separate things is because prices can go up for multiple reasons. It's not just because of the supply of money going up, but it can also be because of shortages or surpluses, or changes in demand or sentiment in the economy. There are lots of things that can throw off prices. And so the question is, since we now kind of understand what consumer price inflation is, just talking about consumer prices going up and down, using the word inflation can kind of confuse things, because it's implicitly suggests that these two are connected. But just wanted to make sure that I clarified that difference. So now, is it happening today? Are prices in the real economy going up? And I think everyone probably knows the answer to this question. Yes, they are most certainly going up at a pretty alarming rate, at rates that we haven't seen in the last several decades. And I talked about this again in my last video. This is showing the updated chart. Right now, we're at around 5.3% consumer price inflation as of August. And if we break it down to category, this is again the August data. Core inflation has gone down a little bit, down to 4% flat. And core inflation just excludes food and energy. All items, again, 5.3%. And again, energy is the main driver of these price increases. So the reason why it's so important to separate consumer price inflation from monetary inflation is because these two aren't 100%, they don't move hand in hand. And so just because you're seeing monetary inflation according to M2, it doesn't necessarily mean, definitely doesn't mean that you're going to have a direct effect to consumer prices, but also doesn't necessarily mean that you're going to see any, given the construction of our monetary system. Because if that money is not actually entering the economy, then it's not really going to change the supply of money, unless banks are increasing their lending and they're actually transporting that money from the financial system into the real economy. So the other thing, and I talked about this again in my previous video, but this is just really important to drive down, especially when we're talking about this. It's very clear that if this was a monetary phenomenon, you wouldn't see such a significant disconnect between categories when looking at price. You wouldn't see certain things go up a lot in price and other things go hardly move in price at all, or maybe a little bit. And so it's really helpful to remember all of the different factors in the equation of price, and how you have supply and demand, you have the expansion or the contraction of the money supply. You also have government intervention and fiscal intervention that's increasing some of the money supply in the real economy, but that oftentimes has very short run effects. And so again, my kind of hypothesis on this is that you're seeing very high price increases in certain categories due to supply shocks predominantly, but you're also having a certain amount of price increases that are occurring because of sentiment in the economy, and also because of stimulus that is now really starting to hit and have those kinds of short run effects because there is a lag um, that occurs between the implementation of said stimulus or whatever program it is and the actual effects thereafter. And so that's kind of the deal with price inflation, and how they can kind of confuse the topic, because just because you're seeing price inflation doesn't necessarily mean it's being driven by a monetary phenomenon. So that is consumer price inflation. And lastly, I want to talk about asset price inflation. So this is another term that I've heard a lot, especially in the last year, year and a half. And I think it's a very troubling term. And I would not be one to really like to use this term, because I think it is again very it can be weird to use, because again it's almost suggesting that inflation drives asset prices up. And while that is partially true and sometimes true, it's definitely not always true. You've had it in certain countries where you've had hyperinflation. Yes, you've had their stock markets going up thousands of percent, but again, they're losing money. They're losing value in real terms, because it's not that their stock market is soaring. It's just that their currency is collapsing. And then in other situations, in the 1970s in the U.S., inflation was price inflation was going up by over 10% a year for quite a long time, almost a decade. And you had the stock market go down in real terms. It was basically, it went down a lot in real terms. It was basically flat nominally, but when adjusted for inflation, it was basically a stock market crash. And so inflation doesn't necessarily drive assets up. Again, this is kind of used as a term for asset price inflation. It just means that, oh, asset prices are all going up. It's asset price inflation, just like consumer price inflation. It's just important to remember, if you're going to use this term, that it's not actually necessarily being driven by real monetary or credit inflation. It's just so just another way of saying asset prices are going up, asset price inflation. So just wanted to make that clear, because I think asset prices are more driven by human emotion and behavior and sentiment, rather than monetary phenomenons, as long as monetary measures are somewhat stable. Obviously, if they're not, then yeah, if the underlying currency is being affected tremendously, then yeah, you're going to have large swings in asset prices. But I would say most of the swings that you see in asset prices, from extremely high prices, like kind of like what we're seeing right now in the housing market and the stock market, a lot of those I think are are driven by human emotion and behavior, which is why I track certain assets like the stock market, like Bitcoin, and I use a framework that aims to measure human emotion through Elliott wave theory. And so that is asset price inflation. The question is it happening today? And absolutely, it is happening today. You're having sky high prices basically in just about every market, especially in the US. And why? Again, I think that is mostly driven by human emotion. Of course, there are many different variables to it, but that is what I find to be most consistent. And so lastly, we're going to talk about signs of real inflation. So we've talked about these different kinds of inflation. We've talked about monetary inflation, the expansion of the money supply. We've talked about credit inflation, the expansion of the availability of money in the economy. We talked about consumer price inflation, prices going up in the real economy, but that not having necessarily anything directly due to the expansion of money, but it can. Then we've also talked about asset price inflation, asset prices going up, but asset prices can go up and down for a number of reasons. Doesn't just have to do with inflation or deflation. But the real concern that I think a lot of people are bringing up when it has to do with this big inflation topic, it is concerning a repeat of the 1970s great inflation that we saw in the US, or perhaps something even worse, especially when people are talking about the dollar crashing. That's a strong take. And that would unquestionably have just detrimental effects to uh, people in a very real way in the country. And so it's very important to kind of be on the on the watch for on this topic, and be aware of these kinds of things, so that you can put yourself in a good position and you can kind of weigh the risks and the rewards and the possibilities at hand in this crazy world. And so the real signs that we want to be looking for are both a sustained and indiscriminate rise in the prices of goods and services. That is one kind of uh, indication that the inflation that is occurring is perhaps something of a greater magnitude, and something that will have a lot of follow through with, something that could last many years. That's the kind of inflation that you saw back in the 1970s. You didn't have certain things going up massively in price and other things basically flat in price. You had a very um, widespread rise in consumer prices that were being driven by um, monetary expansion and credit expansion. You also had interest rates that at one point went above 20%. You had everything. You had gold, and you had everything going up in price, and everything aligned, and that allowed it to be such a rampant kind of inflation. And then you also have other examples like back in 2007 and 2008. And I'll go ahead and go back to that chart where you had um, very high price inflation for a short period of time that had no follow through, and that actually went right. That and the financial crisis is what followed, which was an outright deflationary shock. You had price inflation here in July 2008 at 5.6%. And so prices were going up year over year by that clip, and a lot of people were concerned about inflation. And of course, that was not really something that ended up being a real concern in retrospect, obviously. And that was followed by about a decade of disinflation. And so the real question is whether or not this kind of inflation is going to be something that's long lasting, or if it's just going to be another spurt of prices going up due to supply shocks, due to just lack of production, and and that things are going to reverse and even back out, or possibly even result in another kind of deflationary correction, or permanent shock. I feel that the risks are very high due to some of the troubling signs and lack of real economic growth and credit expansion. So that's what I wanted to cover, looking at that chart. And we can even look at the bar chart here, just looking at the last year. Again, when we're talking about the 1970s, we're talking about an over decade period of time where you had sustained inflation that was backed up by just about every metric, and that was widespread based off category. Not an inflation where you're seeing 4 months, 5 months of 3+% consumer price inflation on an annualized basis that has this kind of um, price inflation rate based off of category, which is very much concentrated in the energy sector. And so what we're looking for, and again, this is not something that you want to see. I'm trying to just talk about this as objectively as possible. I'm just looking at the data. But if you are on the inflationary camp and that's what you are betting on, what you would want to see is inflation that is being confirmed by all categories. Because right now, what I'm seeing personally is most of the price increases are being concentrated in the energy sector, and perhaps you're having a bit of a ground floor due to all of the shocks that have happened, the lack of production, and maybe the increase in costs due to everything that happened from COVID, Maybe you're still having some of those short run effects from stimulus and whatnot that are contributing to the ground floor of increased price inflation in the economy that is hitting uh, food and energy and whatnot. But most of that doesn't seem to be driven by some kind of sustainable monetary factor. Um, and that's why I'm personally thinking that this kind of inflationary impulse that we're seeing that's resulting in higher prices in the short run or the medium run, if it continues for the rest of the year, is not something that's going to be long lasting. Or, when we zoom out into the future, I don't think it's going to be something that we're going to look back on as some kind of second great inflation. Rather, I think a lot of the risk is towards deflation still, um, or disinflation from this time on out, and a kind of slow grind as economic growth and productivity is just not able to be achieved. And you have just a system that is very fragile to any kind of economic shock that may present itself. So that's what I wanted to talk about today. I hope this was helpful and cleared up some things. And if you have any thoughts, reflections, or perspectives, please let me know. I'd love to hear your thoughts on this topic, because I think it's a very interesting and very important topic that may very well impact all of us, because our money and our purchasing power is something that's very, very important to all of us, and has very real impacts to our lives. So would love to hear them in the comments below, and I will see you all next time.